everyone. In last session, we discussed about meaning of accounting, types of account, rules of accounting. Today, we are going to discuss about accounting system, principles of accounting, concept, convention, and last but not the least, accounting cycle. So now, first of all, we are going to discuss about type of accounting system. So student, as you can see, there are two types of accounting system, single entry and double entry. A business entity can record its monetary transactions either on single entry system or double entry system of bookkeeping. Single entry system of bookkeeping is economical, but at the same time, it is unscientific because it does not record all the transactions. Rather, only a few ones are tracked and some are recorded partially, not fully. On the other hand, the double entry system of bookkeeping is based on fundamental principles of accounting, and so it records each and every aspect of the transaction. Now, let's discuss more about single entry system. Single entry is the oldest method of keeping financial records in which an entry is made for each and every financial transaction. In this system, the matching contrasting entry is not made because the transactions are recorded only once. It mainly keeps record of transactions relating to cash receipt and payments. This method of keeping records is primarily used by sole proprietorship and partnership firms. This system does not require high knowledge and expertise for entering transactions. Journals, ledgers, and trial balance are not prepared for it, but one statement, that is income statement, is prepared to know the profit or loss of the business. Now let's talk about double entry system. Double entry system is scientific method of keeping financial records. It is developed by Luca Pacioli, an Italian, in 1494. This system is based on principles of complement, or we can say duality. That is, every transaction has dual aspect, two aspect. Each transaction affects two accounts at the same time, in which one account is debited while the other is credited. Now let's discuss about accounting concepts. Students, accounting concepts are basically assumptions and rules and principles acting as the basis of recording of business transactions and preparing books of accounts. Now, one by one, we are going to discuss about different accounting concepts. As you can see, different accounting concepts are going concern concept, business entity concept, money measurement concept, cost concept, dual aspect concept, realization concept, accrual concept, accounting period concept, and last, matching concept or revenue match concept. Now let's talk about the going concern concept. This concept states that a business firm will continue to carry on its activities for an indefinite period of time. Simply stated, it means that every business entity has continuity of life. Thus, it will not be dissolved in near future. Students, this is an important assumption of accounting as it provides a basis for showing the value of assets in balance sheet. Now, next is business entity concept. Business entity concept assumes that for accounting point of view, the business enterprise and its owners are two separate independent entities. Thus, the business and personal transaction of owner are separated. For example, when the owner invests money in the business, it is recorded as liability of the business to the owner. Similarly, when the owner takes away from the business some cash or goods for his or her personal use, it is not treated as business expense. Thus, the accounting records are made in the books of accounts from the point of view of the business unit and not the person owning the business. This concept is the very basis of accounting. Now let's talk about money measurement concept. The money measurement concept assumes that all business transactions must be in terms of money, that is, in the currency of a country. If we are talking about India, then it must be recorded in Indian rupees. As per the money measurement concept, transactions which can be expressed in terms of money only are recorded in books of accounts. Next is accounting cost concept. Accounting cost concept states that all the assets are recorded in the books of accounts at their purchase price, which includes cost of acquisition, transportation and installation, and not at its market price. It means that fixed assets like building, plant, machinery, etc. are recorded in the books of account at a price paid for them. Next concept is dual aspect concept. Students, do remember that dual aspect is the only concept which portrays the two sides of a single transaction. The law of entire business revolves around only on mutual agreement, sharing policy among the players. How mutual agreement is taking place? The entire principle of business is mainly conducted on mutual agreement among the parties from one occasion to another. The payment of wages, let us take as example. The payment of wages is only made by the firm whenever firm avails services of employees, laborers. What kind of mutual agreement in sharing the benefit is taking place? The services of employees or laborers are taken by the firm through the payment of wages. On the other hand, the laborers are regularly getting wages for their services for the firm. Next is realization concept. According to realization concept, the revenue or income from any business transaction should be included in accounting records only when it is realized. The term realization means creation of legal right to receive money. Selling goods is realization, receiving order is not. Next is accrual concept. The meaning of accrual is something that becomes due, especially an amount of money that is yet to be paid or received at the end of the accounting period. It means that revenues are recognized when they become receivable. Though cash is received or not received, and the expenses are recognized when they become payable, though cash is paid or not paid. Both transactions will be recorded in the accounting period to which they relate. Therefore, the accrual concept makes a distinction between the accrual receipt of cash and the right to receive cash as regards revenue and actual payment of cash, and obligation to pay cash as regards expenses. Students, next is accounting period concept. All the transactions are recorded in books of accounts on the assumption that profits on these transactions are to be ascertained for a specific period of time. This is known as accounting period concept. Students, this concept requires that balance sheet and profit and loss account should be prepared at regular intervals. This is necessary for different purposes like calculation of profit, deciding financial position, calculation of tax, etc. Students, this concept assumes that indefinite life of business is divided into parts, and these parts are known as accounting period. It may be of 1 year, 6 months, 3 months, 1 month, etc. But usually 1 year is taken as one accounting period, which may be a calendar year, that is 1st Jan to 31st December, or financial year. Right now in India, our financial year is 1st April to 31st March. Students, next, or we can say last concept is matching concept. According to matching concept, only makes the entire accounting system as meaningful to decide the value of earnings or losses of the firm at every level of transaction, which is the result of matching between the revenues and expenses. The worth of transaction is identified through matching of revenues, which are mainly generated from the sales volume and the expenses of the firm at every level. Now students, we are going to discuss about accounting conventions. Accounting conventions are guidelines used to help companies determine how to record certain business transactions that have not yet been fully addressed by accounting standards. These procedures and principles are not legally binding but are generally accepted by accounting bodies. But basically, they are designed to promote consistency and help accountants overcome practical problems that can arise when preparing financial statement. Student, there are four types of accounting conventions designed to help or assist the accountants. The first one is consistency. A company should apply the same accounting principles across different accounting cycles. Once it chooses a method, it is urged to stick to it for future unless it has a good reason to do otherwise. Without this convention, investors' ability to compare and assess how the company performs from one period to next is made much more challenging, difficult. The second one is disclosure. Information considered potentially important and relevant must be revealed, communicated, regardless of whether it is detrimental to the company or not. Third is student conservatism. Playing it safe is both an accounting principle and convention. It tells the accountant to err on the side of caution when providing estimates for assets and liabilities. That means that when two values of a transactions are available, the lower one should be favored. The general concept is to factor in the worst case scenario of a firm's financial future. And fourth one is students' materiality. Like full disclosure, this convention urges companies to lay all their cards on the table. If an item or event is material, in other words, important, it should be disclosed. The idea here is that any information that could influence, affect the decision of a person looking at the financial statement must be included. Now students, we are going to discuss about accounting principles. Accounting principles are the rules that an organization follows when reporting financial information. A number of basic accounting principles have been developed through common usage. They form the basis upon which the complete suite of accounting standards have been built. In India, Institute of Chartered Accountants of India (ICAI) issued accounting principles, which must be followed by firms. Now students, we are going to discuss about accounting cycle. Student, accounting cycle is the sequence of steps involved in accounting process. Accounting cycle starts with the identification and recording of financial transactions of an organization and ends with the preparation of final accounts for the accounting year. The cycle continues for the next accounting year with the opening balances of assets and liabilities, which are the closing balance of the preceding year. The steps involved are: first, identifying the transaction and journalizing; second, posting and balancing; Third, preparation of trial balance. Fourth, preparation of trading account. And fifth, profit and loss account. And last but not the least, preparation of balance sheet. Student, all these are going to be our next units. Now let's discuss about subsidiary books. Students, accounting can be tiresome process. A company has thousands of financial transactions in a year, and journalizing them all can get quite bothersome. So some companies choose to prepare subsidiary books in which they record transactions of similar nature in chronological order. Subsidiary books are books of original entry. They are also known as day book or special journals. They are helpful in overcoming the limitations of journal book or journal entries. In the normal course of business, a majority of transactions are either related to sales, purchases, or cash. So, we record transactions of the same or similar in nature at one place, that is, the subsidiary book, and we record these transactions in chronological order. Different types of subsidiary book are cash book, purchase book, sales book, purchase return or return outwards book, sales return or return inwards book, bills receivable book and bills payable book, and last is journal proper. Now let's talk about each and every one by one. First, we are going to discuss about cash book. Students, cash book records all the cash and bank receipts and payments. It is a book of original entry as we record transaction in it for the first time from the source documents like vouchers, invoices, etc. A cash book has a debit and a credit side both. Thus, it is similar to a ledger account. Therefore, it acts as a subsidiary book as well as a ledger account. Any organization can maintain a single column, double column or triple column cash book as per their requirement. In single column cash book, there is only one column, that is cash column. A double column cash book consists of cash and bank column, whereas the triple column cash book consists of cash, bank and discount, as you can see in the slide. Usually the firms use triple column cash book. Some organizations also maintain a petty cash book which records the petty or small cash expenses of the firm. Now let's discuss about, students, the purchase book. The purchase book is a book wherein purchases are recorded. A firm records all its credit purchases of goods in purchase book or purchase day book, while it records all the cash purchases of goods in cash book. Students, do remember that we do not record purchases of assets in purchase book. Thus, they are going to be recorded in special book, journal proper, which we are going to discuss later on. Next is purchase return or return outward book. Students, we record the return of goods purchased in purchase return book. A debit note is prepared for every return of goods in duplicate. It contains the name of the supplier, details of goods returned and reason for that. It needs to be dated and serially numbered. Now let's talk about the next book, that is sales book. A firm records all credit sales of goods in the sales book or sales day book. It records cash sales of goods in cash book. Students, we do not record the sale of asset in sales book. It is going to be recorded in journal proper, like purchase of asset as we discussed earlier. In this case, we record entries from the source document. We also record entries with the net amount of the invoice. Now, let's discuss about sales return or return inwards book. Students, we record the returns of goods sold in the sales return book. A credit note is prepared for every return of goods in duplicate. The credit note contains the name of customer, the details of goods returned and reasons thereof. It also needs to be dated and serially numbered. The sales return book is thus maintained. Now, next is bills receivable book. Students, we record all the acceptance of the bills in our favor in the bills receivable book. We need to post the total of bills receivable book to the bills receivable account. Do remember that we need to post the individual accounts of the customer in it. Now, next is bills payable book. We record all the acceptance of the bills that we issue in favor of others in bills payable book. We need to post the total of bills payable book to the bills payable account. Also, we need to post the individual accounts of the supplier. Now, let's discuss about journal proper or general journal. I repeat, journal proper or general journal. It is a simple book of chronological record of business transactions. The use of this book is very much restricted in modern accounting system. Only those transactions which cannot be conveniently recorded in any of the other books of original entry, that is subsidiary book, or which are not sufficiently numerous to necessitate a special book being devised for them, are recorded in this book. Now, let's discuss about different transactions recorded in journal proper. First is opening entries. These entries are needed for opening accounts in the beginning of financial year. All assets accounts are debited and all liabilities accounts credited, and the difference is credited to capital account. Second is transfer entries. These entries are needed to record transfer from one account to another. Like an asset purchased is wrongly debited to purchases account. Then to rectify the mistake, the following entry must be passed. Like what we have done? We purchase the asset and we record it in purchase account. So, reverse of it is asset account debit to purchase account. Rectification entries. When certain errors are committed in the books, these entries are passed. In order to nullify the effect of errors, let us take example. Goods sold for rupees 10,000 to Mr. Y has been entered in sales day book as rupees 100. This mistake is corrected by passing the nullifying entry. Next is adjustment entries. When accounts are closed at the end of a financial year, before preparing final accounts, certain adjustments have to be made relating to certain items like depreciation, outstanding expenses, interest on capital, etc. Next is closing entries. These entries are needed at the end of accounting period to close certain accounts, transferring their balances to some other accounts does this. Next is compound entries. Sometimes compound entries are passed through journal proper to make the record of the transaction more clear, like goods sold for cash after allowing trade and cash discount can be recorded in this journal. And last is casual entries. Journal proper may also be used to record such transactions which do not occur so frequently, so that a separate book may not be provided for them. Like if sales returns are rare, then instead of opening a sales return book, in such rare case, we can record it in journal proper. So with this, students, we are ending our unit number 1. And next time, we are going to discuss about the new topic. Thank you.